Why do banks buy so much life insurance? Why on earth do banks buy the most amount of life insurance than any other entity, company, or person on the planet? In this video, I'll tell you why. This is Michael Santonato here with How to Become Financially Indestructible. Reason number one, a life insurance company is far more stable than a bank. In 2023, 3 major banks in the United States went bust, went bankrupt, went kaput. A bank is 10 times more likely to go bust than a life insurance company. Why? Life insurance companies are mandated by their government, specifically here in Canada, to have 2 times the amount of cash on hand, just sitting in their accounts for as many death benefit policies that they need to pay out. For example, if a life insurance company has $100 million in death benefit dollars to pay out, they must have $200 million in cash, simply in cash, in reserves, as mandated by the Canadian government. The next reason is a lump sum tax-free benefit that is paid upon death. So in other words, when the person passes, the life insurance company has to pay upon the death a lump sum tax-free benefit to the person, estate, company, or individual who's purchased and owning the policy or who is listed as a beneficiary. Yes, companies can be listed as beneficiaries on life insurance policy. The next reason is that it grows at a very conservative, very reliable 6 to 8% per year. This is entirely conservative. Banks hate risk. Banks are alien to risk. They like to eliminate risk, like most of the world's wealthy people. They want to eliminate risk. And so life insurance is an extremely conservative, reliable, predictable potential of 6 to 8% annually in terms of an ROI. And again, I'm going to tackle that tax-free part. Since taxes account for about 30% on average, or higher in some cases, it's a great thing to avoid. So having a tax-free lump sum payout is a brilliant plan. The next reason is they can be leveraged, sort of like when you own a house. If you want to pull money out of the house to use for investment or some kind of financial use, you don't have to sell the house in order to use the money that's in the house or the value or equity of it. You can simply refinance your mortgage and then extract some of that value or equity and cash out for other purposes. It's the same with life insurance. As your life insurance policy grows, in the case of a whole life or universal life policy, you can use that cash value for different purposes and take a loan against it, which again is a tax write-off, which banks and individuals love. The next reason is you can buy as much as you want. There's no limit. Like TFSAs and RRSPs have limits and ceilings, life insurance policies do not. You can buy as much as you want to your heart's content. The next reason is banks can buy it on all of their employees, and banks typically have thousands and thousands of employees, and they can buy and they do buy life insurance policies where the bank is the owner on the policy of the life of the employee. So the bank gets paid if the individual dies. This is extremely smart and extremely brilliant for all the C-suite level and above executives. The next reason is because banks lend out so much money for buildings and builders and contractors and businesses, they often have a requirement where if they're going to lend X amount of dollars, they will do so. But in the event of the person who's taking the loan dying and passing prematurely before being able to pay off the loan, the bank recommends and requires in often cases that the bank be the owner of a life insurance policy on the individual so that if the person dies and they can't repay back the loan, the bank gets paid the life insurance money. Another reason is because in Canada, there is an institution called Assuris. Assuris, ASSURIS, is the company, the governmental body, if you will, that is the backup should any of these life insurance companies default or go bust or bankrupt, which is highly unlikely. Then Assuris will be the responsible party for covering those death benefit payouts, which means still the policy owner, in this case the bank, or you if you have one for your family, will still be covered for the death benefit by Assuris, even if the company where you purchased the life insurance policy from cannot pay. Less risk, more conservative, more reward. The next reason is life insurance companies are so old. So many of them go back 100 years, 200 years. Life insurance laws predate tax laws, and so life insurance is an extremely reliable institution to purchase an asset or investment from. It's the lowest risk. It's one of the best performing consistent assets with the lowest amount of risk. And banks, like I said, if you're listening, love eliminating risk. They love eliminating risk because they hate risk. So they pass the risk off to the insurance company. These have been some of the reasons why banks buy so much life insurance from life insurance companies. Ask me for some of these other great reading materials to further back up this concept. If you'd like to check out some of my online courses, you can do that in the link below this video. And if you'd like to reach out to me to discuss life insurance or any other assets, questions you have about financial products, you can book a call with me also in the link below. For further information, I highly recommend the book by Nelson Nash, The Infinite Banking Concept. Do your own research, have fun, and enjoy learning about financial concepts because knowledge, when it comes to money, really is power.